Hi everyone, welcome to the final week of your accounting class. I am sure that you are more than excited that this is the last homework assignment you'll have to do. So let's start right in. We have four problems this week. So pretty much the hardest one is the first one. So let's start with a P11-26 and let's start with requirement one. What we're doing is we're looking at payroll taxes. And the important thing to keep in mind is, and if you think about this, whenever you get paid, obviously taxes are taken out of your payroll, out of your salary. So what we're doing here is we're looking at the employee, Lewis Welch, and we're calculating in this first problem, we're calculating the his salary and his gross pay, and then deducting the taxes. And we're going to go through as to how you actually do those calculations. So this is the first requirement. So the thing that you want to remember is the information that you're being given in the problem. I believe they give you just the monthly balances, the monthly amounts that he makes. He makes $10,200 on a monthly basis, but here we're calculating for the entire year, payroll for the year ended December 31st. So when you're calculating salary, make sure that you're going to multiply that by 12 months. The bonus is calculated by just taking the percent of the bonus over the total salary for the year. So you take the total salary that you calculated up here, and in order to calculate the bonus, you multiply it by the percent that they're giving you in the problem. Now, the hardest part is your deductions. So the important thing to remember is that, first of all, with the federal income tax, they pretty much tell you what the tax is. They tell you that there's a monthly amount plus a sum amount at the end. So you want to calculate all those together. Um, and so that's relatively easy. The state income tax, they also tell you what the monthly what the monthly amount is, and as well as what it is on the bonus. So they give you pretty much the federal income tax and the state income tax. Just remember to add to multiply it by 12 and to add the bonus tax in as well. With FICA, it's split into two categories: FICA OASDI and FICA Medicare. And you want to use the same rates that are given in the textbook. So what they give you in the textbook is that for FICA, OASDI is 4.2%. But the important thing to remember here is that it's 4.2% on the first $110,000. I'm sorry, $110,100. So you're only multiplying the 0.042 times the, sorry, I'm having a hard time finding the multiplication here. So you're multiplying 4.2% times $110,100. So there's a max. So regardless of how much they owe, I'm sorry, how much they earn, FICA only takes it up to the first $110,100. So you only want to calculate it on that amount. Now, FICA Medicare is 1.45%, and that's going to be on the full amount, the full salary, the total gross pay. Okay, so there's no max on that. So whatever is the total gross pay, you calculate 1.45% on that. The charity fund is given to you as 1% of the total gross pay. And then life insurance is $12 a month. I'm sorry, $5 a month. So you want to calculate that out for the entire year. And that would bring you to your total deductions. So you're going to have your total gross pay here. That's a combination of your salary and your bonus. Remember, it's for the entire year. And then you're going to have a total of your deductions. You're going to subtract that in order to get the net pay. And that's very similar to what happens in your paycheck each biweekly or each week. Is you get a total gross pay, and then there's deductions for taxes, for FICA, for any kind of other things that you might put in. So in this case, life insurance and a charity fund that they donate to, and that would give the net pay of what the Lewis Welch actually brings home. So requirement two, though, is looking at the employer payroll expense for the year. So on top of the taxes being taken out from the employee, what the employee pays into it, the employer also has to pay into the taxes. So besides what you're paying, what Lewis Welch is paying, the employer also has to pay additional tax. Okay, so we're going to take a look at that. So your gross pay is going to be the same as what you calculated in requirement one. And then for the FICA OASDI, again, there's a max on the $110,100, but in this case, the rate is 6.2%, and this is right from the textbook, and that's multiplied on the first $110,100. Your FICA Medicare is going to be 0.6% on the full amount, the total gross salary. Okay, so again, there's no maximum of the 110,100. It's on the total gross salary. So it's 0.6% times the gross salary. Now here, the federal unemployment tax, every employer has to pay into the unemployment fund, and that is on a max of $7,000. So only, regardless of how much the person makes, it's only going to be paid out on $7,000. And that rate is, I'm sorry, I need to go back here. I picked up the wrong amount. For FICA Medicare, it's 1.45%. Under here, federal unemployment tax, it's 0.6%. Sorry for that confusion. I didn't want to start the whole thing over again, so I hope I didn't confuse you too much. And that's on $7,000. So 6% of $7,000. Your state unemployment tax is 5.6% on $7,000. Okay, and that would be your total employer payroll tax are those four things combined. Then any kind of benefits also are taken out, and they give you what the retirement benefits are. I don't need to go over that. It's given to you in the problem. And the health insurance they also give you, and that's on a monthly basis, so you need to multiply it by 12. So you're going to come up with your total benefits here. So you're going to have your gross pay, you're going to have your total employer payroll tax, and then you're going to have your total benefits here, and you just add all that together to come up with your total payroll expense. And that's the total, what it's going to cost the employer for the total payroll. So it's going to include your salary, the gross salary, which they have to pay. Then it's going to include the payroll tax that the employer has to pay, and then any benefits that they're contributing to the employer. Okay, so this is for the employer payroll expense. In requirement 3, we're looking at the journal entry. And the journal entry is going to be pretty much the same as requirement 1. You're going to use the same numbers as from requirement 1, but you want to follow the example on page 675. Now, the only difference here, and you're just doing a journal entry based upon the numbers you calculate in requirement 1, the difference here is that in the textbook on that example, they have a salary and wages payable. In this case, we're not setting up a payable because we're actually paying out the amount, so there's no payable set up. Okay, so for requirement 1, again, if you want to go back to requirement 1, let me see if I can do that. Well, let me just tell you, requirement 1 is going to, you can look at an example on page 670 through 674. For requirement 2, you can look at pages 675 through 677 as an example. And then for requirement 3, you want to look at page 675. Okay, 1128. The next problem is pretty straightforward. I don't really need to really go into this problem too much. What you're doing is you're journalizing some liability transactions. So just take a look at that. It's pretty straightforward, just journal entries like we've done before. And then in requirement 2, you're just going to do the T account for that estimated warranty payable. So go back to the text on warranty, and that should be pretty straightforward on how you do this problem. For CP 1135, requirement 1, 2, and 3, let's take a look at that. So on this particular problem, what we're doing is we're accounting for liabilities of a known amount, and what you're doing is you're recording a 300,000 note payable. So they take out a note payable on March 1st, 2014. So you want to record that entry right here in your first entry is recording that full note payable that is being taken out on March 1st. Then on the second entry, you're going to record the entry to accrue interest due on the note at December 31st. So you want to calculate what the interest is based upon the $300,000. And the important thing to remember here is that we're not doing the full year because it was taken out, the note was taken out on March 1st and the year ends December 31st. So you want to calculate the correct number of months for that. And then finally on March 1st is the end of the first year of that loan, and we're going to be paying off 1 year of that loan. So we're not paying off the full amount, we're paying off just 1 year of the 5-year loan. And so we want to then calculate that 1 year amount of the note that we're paying, along with we're going to get rid of the interest payable from December 31st, and then we're going to have an interest expense for the amount for 2 months because we have January and February. Okay, so that explains CP 1135, and then CP 1347 is relatively straightforward as well. What you want to do in this particular problem is you want to refer to page 781, and that's pretty straightforward. They give you a lot of superfluous information in the problem CP 1347, so don't be thrown off by that. There's some information in there that's just not pertinent to you doing the problem, so don't be thrown off. So just take a look at page 781 and follow that example for both the common stock and the preferred stock. Okay, I hope that helped. If you have any questions, please contact me either through the individual forum or the question to instructor forum, or my phone number is 602 639 7378, and I'm available Monday through Friday, 12 to 8 p.m. Arizona time. Thanks so much, guys, and it's been a pleasure having you in class. I wish you the very best of luck in your future classes.